We're back again, Matthew Piepenburg and myself, for another MAMChat. And, you know, Matt, we're looking at now a pretty quiet summer, and that's a good time to reflect and to plan for what's coming next. And you know, we don't know, but it could very well be that this is the calm before the storm, and the autumn will be quite violent. Certainly, we have all the underlying factors for that, and that's why we again want to speak about markets and gold in relation to wealth preservation. I mean, you talked about, Matt, the centralization of power, if you will. And of course, you know, that started hundreds of years ago, or even further ago, because you're looking at, you know, just take Mayer Amschel Rothschild in the late 1700s, one of the fathers of modern banking, if you want, that, you know, said at the time, when he was in Germany at the time, he said, allow me to control and issue the money, and I care not about who makes the laws. And that's what we're seeing today more than ever. You know, from that time, you know, now in the modern era, the last 100 or so years, the Fed was created on Jekyll Island around the idea came around in 1910 with this meeting on Jekyll Island, and 1913 the Fed was started, and that was a private bank controlling the US dollar. And then, of course, you know, that was quite already important concentration in a number of bankers controlling the politicians, controlling the financial system. But, you know, we've talked about debt. Debt is now going up exponentially since 71, when Nixon closed the gold window. Or global debt has gone from 4 trillion to 325 trillion. 4 trillion to 325 trillion. And, you know, you could have said that, why don't I actually try to balance budgets? But it's in nobody's interest. It's not in the finances' interest or the bankers. And since they actually grease the hands of the politicians, it's not in their interest either. So what has happened is that this enormous buildup of debt has suited everybody. It suits the bankers, it suits the politicians, and nobody cares about the size of the debt, because now there is now more concentration of power than ever in the world. And that's obviously concentration in the banking system. Just take BlackRock, you know, the biggest investment company in the world, with assets of $10 trillion. $10 trillion is, it is 2 to 3 times GDP in Japan, Germany, France, each country separately, not together. I'm talking about France, UK, etc. You know, so you have one investment company controlled by one man, and a team, of course, but one man is actually controlling more assets than GDP of most countries in the world, except for the US and China. So, you know, that's a real concentration of power. And that goes on, of course, because that leads to the political concentration, that leads to corruption. You know, you could ask, why is it that Trump has got 4 major lawsuits trying to put him in jail, but the president's son and the president, who have operated, or the son at least, with the help maybe of his father, operated for years in Ukraine, which is seen as the most corrupt country in the world, but there, you know, nothing happens to them, to Hunter Biden or his father. But Trump, who nobody wants in power, you know, they find all kinds of ways to try to put him behind bars. I'm not taking sides. I'm just saying that money has enormous power and enormous influence for the ones who are actually running the show. And of course, as I said, if the financial markets or the guys controlling the big financial corporations banks, BlackRock, etc. I mean, they obviously use that to power of the money to influence whoever they want to influence. So sadly, that leads to a corrupt world and a world that's building up debt, as I said, exponentially. When Reagan became president, U.S. debt was $1 trillion, the federal debt, and now it's 32 trillion, and going up exponentially, or right now, because it's going up faster than ever. This is why, Matt, as you know, we as a company started to worry about that debt. Yes, you can build it up for longer than anybody believes is possible, even after the crisis in 2006-9. But we're getting to a point when the risk is high, and that's what we're looking at. We can't time exactly when this bubble will burst, but we know about the risk. And therefore, we came to the conclusion already end of the 1900s that gold would be, as a consequence of this risk, gold would be the best way to protect your assets. And that's what we've been doing for our investors and for ourselves for the last 25 years or almost. And now it's building up to something more dangerous than ever. Gold moves up slowly, normally, gradually, with the debasement of currencies. But then all of a sudden, something happens, chaos, or something happens in markets. We've seen that with COVID. We saw it with the banking crisis, the 4 banks that went under in the US in March, and then Credit Suisse, etc. So those kind of events, they make a fast move in gold, and then it stops again and rests, like we have seen all of the summer now. Gold has been going sideways. So it's absolutely essential, in our view, to protect against the risk that we're talking about here. The global debt of 325 trillion, derivatives of maybe 2 quadrillion, so we know that gold throughout history has been the best way of protecting your wealth. Now, but it's not enough to hold gold. There's also a question of how you hold it, where you hold it. And maybe you can tell us a bit what your thoughts about that, Matt.
Yeah, I think it's a very important question, Egon. And without flattering you, you knew this decades ago when you started Matterhorn. I mean, let's be honest. I mean, you say we, but you did this decades ago. People might have thought that was a little loopy to be so, I think, openly disconcerted about banking risk, currency risk, and political risk 20 plus years ago. And yet all those things that were clear to you then are now coming to fruition at a faster pace. To your point, BlackRock might as well have its own UN seat and its own flag and its own nationality. It's got more power than most countries.
Yeah.
And in the United States, where I studied constitutional law and history and the ideals of the founding fathers, we had 3 branches of government: the judicial, the executive, and the legislative. Now we have a 4th branch, the monetary, which is the Federal Reserve, a private independent bank, which is neither federal nor reserve, or frankly constitutional. It has more power in some ways than any other branch of our government. So yeah, the why gold is now obvious. The debasement you were thinking about decades ago is now obvious. The centralization is now obvious. The banking risk is now obvious. The currency risk is now obvious. It's no longer theoretical or the fringe concepts of kooky macroeconomists. It's sound thinking. And so yes, why gold is pretty clear. And to your point, where gold was something you were equally clear about 20 plus years ago. Gold Switzerland isn't just a URL, the name of an entity. It's a thought process of where are the safest jurisdictions. And people may say, well, we have a bias because we have a Swiss focus or Swiss citizenship or Swiss residency. But the simple fact is we've looked at jurisdictions. We don't talk about this as much as we should. And you were looking at this years ago. We've looked and we've talked as a team for years about different jurisdictions, including Singapore, which is considered the Switzerland of the East, and now Dubai, the Switzerland of the Mideast. And it's always the Switzerland of something, because Switzerland is still, despite its flaws, the standard. And we've looked at New Zealand, the Caymans, the USA, Austria, Germany. We looked at Panama, Hong Kong. What needs to be said as a conviction rather than a jurisdictional bias is when you're looking about where to hold gold jurisdictionally, you've got to be thinking about numerous evidentiary patterns of wealth preservation. That means monetary and fiscal stability, political stability, rule of law, a sound system, a sound government. These things are very, very important to us. We've looked at other jurisdictions trying to see where could we be wrong, where could we be creative. And the simple fact is, without bias, Switzerland and Singapore, to a large extent, are the best options. In an imperfect world, they're not perfect. Each of these places have issues, Switzerland, Singapore, least of which, but even in the Caymans, you have it's basically a UK banking regulated offshore jurisdiction. Panama, which we won't look at, the vault quality is horrible. New Zealand is under the Five Eyes program. Hong Kong is a little too close to comfort to China, including New Zealand. So there is no perfect place, but in an imperfect world, the jurisdiction choice for Switzerland remains true to its stability and its history and its government.
But also, jurisdictions obviously critical, but also the way that investors hold the gold is very important too, isn't it?
Well, that's another thing. Again, Egon, without we're partners, and it's not flattery, but you knew this years ago. You certainly you don't hold it under a mattress. That's incredibly dangerous. Then you have the next two choices, which are commercial banks and ETF instruments or trusts. And again, we will do more in the coming months to make these very clear in our white papers on the goldswitzerland.com website, so this becomes very clear. But in a few minutes, let's just be clear. Commercial banks have massive amounts of operational risk, as we've seen just recently this year, and we've certainly seen in Credit Suisse's implosion. Again, things we've warned about for years.
And they had lots of gold, still have probably, for very wealthy holders around the world, big amounts of gold. Absolutely. UBS too, but because it shows you.
Absolutely. There's safety in numbers. There's a sense that commercial banks are safe and that there's just too big to fail and that your gold is safe there. If you look under the hood, that's simply not true. First of all, we've seen failure of delivery in precious metals with HSBC and Morgan Stanley when you needed it most. Most of that gold, allocated or unallocated, isn't really liquid. It's not available when you need it. There's a daisy chain of middlemen and intermediaries in those banks. The banks then rehypothecate the gold that they say they have on their books. In short, it's really not there. And again, we could spend a lot more time on that, but commercial banks, and we'll give more detail, and we will, on this, and we have in the past, but we'll focus on this. And an ETF instrument is simply part of the banking system as well. It's a paper promise that you're going to get gold, but you really don't have it. There's a daisy chain from the central banks to the commercial LBMA banks to the ETF trust itself, where again, it's a paper promise. It's not real actual gold. And there are immense amount of intermediary risk there as well. It's highly liquid. It's easy. It's great for traders. It's certainly not good for wealth preservation. So again, the ETF option, the commercial bank option, the under the mattress option is really not a safe option for an investor thinking about wealth preservation and making serious investments in gold and silver. This was the bedrock of your thinking 20 plus years ago when we created the best vault, found the best jurisdiction, and the best way to own. So again, it's not to grandstand Matterhorn, but you're decades ahead of your time, not only in the macros, but in the way of and the where of owning it and holding that gold. And I think it's something we have to be more vigilant about in directing that to readers and viewers who come to our website and who come to us. But it's fairly obvious.
Also, of course, the fact that they hold it in their name directly, have direct access, physical access to look at their gold, to touch it, to take it out if they want. I mean, that's so important, not to hold it through another entity where they have part ownership, or where they have to go through this entity to actually touch their gold, to see their gold, get it out. I mean, that's also critical, isn't it?
Absolutely. Look at GLD. You want to see and touch and audit your gold. You want to call someone. Good luck finding someone at HSBC who's custodying that gold to then find you the vault manager to give you access to that gold. And let's say you even have an allocated, segregated account in a commercial banks on, you have 100 ounces of gold. Well, there may be a 400-ounce bar with three other people's name on it, including yours. So you want to cut that bar by 1/4 to get access to your gold when you need it most? In other words, it's really not earmarked to you as an individual. There are so many hiccups along the way of quote unquote commercial bank-owned gold, and not to mention delivery failures and hypothecation and daisy chain intermediaries. These are things that we've eliminated at Matterhorn, and also a bedrock vault system that is the safest in the world.
Absolutely.
So the where and the how are very important questions in addition to the why. And we understand that, we make that very clear, but we need to do better at making that more clear. Now, there's the other question for you, Egon. Again, there's a difference between a wealth preservation gold investor and a speculator in gold, or a number chaser, a top and bottom chaser. I'd like to get your thoughts. I think people should hear your thoughts just on, when people ask about pricing or is gold not doing enough, when, last year was at 1,600, this year it's 1,900 to 2,000, it's still not doing enough. And as to your point, gold doesn't really have to do anything. Currencies just have to get weaker. But measuring currencies or measuring gold by fiat currencies is inherently kind of silly, I think. But talk a little bit about gold pricing without being a speculator or a crystal ball holder, and to viewers who are asking about pricing, because we get that a lot. We do, and we have to address it.
Well, the one thing that I've learned is to have patience, and that over time, governments will continue to debase the currency, which is another way of saying that gold is actually not going up, but it's the currency that's going down. There are periods when gold is going up faster than cost of living. But overall, what gold does is to reflect stable purchasing power. So that's why when you buy gold, and this is what our clients, when they buy gold primarily for wealth preservation, they're not worried about that the price going up or down on a daily basis, and they're certainly not, speculating in a way of buying and selling gold regularly. They buy gold to hold it for wealth preservation, and over time, gold always goes up. But there are periods, of course, we had a fast period when we started from 300 to well over 1900 in 2011, and then we've had a period of correction back and forth for years now. But again, that we know that the next phase is going to be much more vicious and much faster. So we're not worried about the gold going sideways. In the meantime, our clients, they are protected, and they have the safest asset you can ever hold from in money asset, if you want, and which is totally liquid also. So I'm sure that the problems and the debt that we talked about, gold has not reflected the massive increase in debt that we have seen in later years. In the last 4 years, the US, for example, has created 20 trillion debt. It's just unreal. And gold hasn't reflected that. But we don't care, because we know it's going to happen, and there will be a catalyst for that. But until then, you should just look at gold as holding a number of kilos or ounces or grams of gold, that it's for a rainy day. Yeah. And that over time, it's inevitable that gold against paper money, which will die, which it always has. And don't believe that another currency like CBDCs, central bank digital currencies, don't believe that that's going to save the system at all. It's just another way of temporarily giving control to the central banks, because they're going to lose control of their existing currencies, the dollar or the euro, etc. They're going to become worthless, and then they create something else that they think will replace it. But you can't replace one form of paper money with another form of paper money, even if it's digital paper money, because it's worthless. Right. So whatever they try to do, in the end, gold will reflect that.
Absolutely.
But as we said, to get, I think the next move in gold, I think the central banks around the world are going to stop to hold dollars as a reserve asset. Every central bank holds dollars as a reserve asset. But who the hell wants to have a currency controlled by a government that can confiscate your reserve asset, at a whim, whenever they want, like they've done for Russia, for example? So, much better to hold than the world's longest currency, 5,000 years, has always maintained its value. Yeah. And that's, I think, what central banks are going to do. I think they will move away from the dollar as a reserve asset. I'm not talking about as a trading currency, I'm talking about as a reserve asset. They're going to move away from the dollar to gold. Mm-hmm. And of course, there isn't enough gold in the world to replace all the dollars they hold at the current price. So what that's going to mean is, over the next X years, whether it'll happen all at once or it can be gradual, there'll be a repricing of gold. And whether that's a repricing to 3 times or 5 times or 10 times or even more the gold price, that's not a forecast. That's just, there'll be a natural consequence of a shift of monetary assets and reserves to the most stable currency in the world. And therefore that will be reflected in the gold price. But I know that it's not worthwhile giving a forecast to where, when and how much, but it's going to happen, and therefore people should be prepared now, not later. But what will trigger that move at various points will be some kind of chaos, because that's what gold likes. Gold likes chaos. It always goes up over time, but normally the trigger of the real moves, rather than being slow and gradual, they're quick and short. Maybe you can talk.
Well, I always use the analogy to our theme on debt. It's a massive red balloon with so many needles, macro needles, trade needles, credit needles pointed at it. It's hard to predict which needle will pop these credit and debt markets. It doesn't really matter. It's usually not the thing you expect that breaks the system. And we can speculate. I've talked about in recent interviews about the Japanese carry trade. If the Bank of Japan raises rates, that'll unwind massive amounts of leverage in U.S. markets because they're borrowing cheap yen to leverage an arbitrage. Market speculation in the U.S., that's one thing. There's so many things. We've already seen the credit markets beaten down, the gilt market beaten down by rising rates in the U.S. market. We've seen bank failures in the U.S. this year. We've seen repo markets imploding and eating bailouts. We've seen the U.S. Treasury tank in 2020. Last year, we saw, to your point, central banks dumping U.S. treasuries and stacking U.S. gold at record levels. So it's not even predicting anymore. It's actually happening in a frog boil right now. The loss of faith in an indebted IOU from an indebted country like Uncle Sam, which exports its inflation, has no chaperone on its currency, and is debasing a dollar, which no one wants. And any number of credit events can break it. It reminds me, it's a crude analogy, but we've all been to college. We've all been in our 20s. We've all seen those group of friends drinking too much, watching some fall off the chairs first and the others eventually. But when you drink enough, you're going to fall off the chair. You're going to have the hangover. And watching America right now with its debt arrogance and this notion that we can solve debt with more debt and then pay for that with debased money printed out of nowhere, it's comical. It's drunken teenage leadership of our financial system. It's like college frat boys. And so it's interesting just to sit back and watch these well-dressed teenagers in charge of our policy get drunker by the day and just see who falls off the chair first. None of us can time when the last martini knocks them off the chair, but it's interesting for us to be protected and preserved and watch it happen without having to time it by quarter, day, or year. It's simply inevitable. So those are my thoughts. Egon, I don't know if you have any final thoughts, but these things are tragicomical in a sense right now, realistically.
Yes, and the dilemma that people have is that they think markets always go up, stock market always goes up, bond market always goes up, property market always goes up, and because the Fed is always, or the central banks have always saved them with more money printing. Nobody realizes that we are at the end of an era, an end of a major cycle, in my view, and whether that's a 100-year cycle or 300-year or 1,000-year cycle or 2,000-year, we will, the future historians will write about. But the risk is here now, right now, and here. And that's what people should think about. The stock markets are overvalued, bond markets are overvalued. We will have high inflation and high interest rates for a long time to come. It's not a straight line, it's volatile, but the inflation has turned, interest rates have turned, and stock market is overvalued by any measure massively. And property market has benefited from zero interest rates and unlimited amounts of money lending, and they're already suffering now, especially commercial properties are suffering. So, there are no good, safe investment markets now, except for probably hard assets, commodities, which are massively undersold compared to all of these bubble assets that I mentioned. And obviously gold and silver. So people should think about protecting their wealth now. You don't buy after the panic. You buy before. You can buy in an orderly way now and get decent prices, get rid of some of your bubble assets. And to protect the wealth for yourself and for your family today. And this is a long-term insurance, life insurance, I would call it. And that's what people should really think about now and not wait until things happen. And once they've done it, they know they have a safe asset. It's not going to go away. Gold has never gone to zero. will never go to zero if you're talking about physical gold, and that you actually have direct access to. It's not going to go to zero. And it's likely, as it always has, to reflect the debasement of the currencies. So it's that's what we recommend, and it's not, people don't have to come to us. We offer a service, of course, but there are others too. You can compare. We think that our service is superior, but obviously one should look around, see what there is. But please, I implore investors to actually look at preserving your wealth for yourself and your family for future years.
Yeah.
So I think, Matt, we've now I've talked about a very important subject, and hopefully some people will take heed.
Yeah.
Thanks. I think it's been a very, very important discussion, and look forward to the next time, Matt.
Always a pleasure, Egon.
All right. All the best. Thanks. Bye. Bye to our viewers.